Hello, everybody, and welcome to the Ignatius L. Jackson CPA YouTube channel. So today we are talking about an awesome topic. Can you guess what it is? You probably can based on the heading of the video, but it's about cost segregation studies. Today we are talking about how to save tons of money on taxes when you're doing real estate by doing something called a cost segregation study. So if you want to figure out how to save thousands in taxes by doing a cost segregation study, you should probably stick around and listen in, watch however you're going to do this, and you might learn something new and cool that you can do. All right, so we will be right back with you in a second. Stick around. All right, and we're back. Thanks everybody for tuning in to today's episode of the Ignatius L. Jackson CPA YouTube channel. Please don't forget to subscribe, like, share, all that great stuff. Comment on the channel if you have any questions. We're here to try and help educate you on a few different things you could do to save yourself money on taxes, to give you some financial know-how and wherewithal to maybe build some generational wealth. And so that's what we're here to do. So today's topic is about cost segregation studies. Okay. It's a powerful tool for you to utilize when you're investing in real estate. But it's not necessarily for everyone. And we'll explain what we mean by that. Okay. So if your full-time job is something unrelated to real estate and you don't own a business that does real estate, okay, and your rental properties are not short-term rentals, okay, then a cost segregation study may or may not make sense for you in most cases. Reason being is you probably don't have enough income to help offset those losses, and so those losses that you're going to accumulate from the cost segregation study will continue to grow over time. I mean, there's going to be in your passive activity loss bucket, right? Which is on form 8582 of your tax return. If you're ever looking at that, go look at your tax return and look at for form 8582. If you see that form, that basically means you've accumulated losses that you're not able to take and offset against your other income that you have. And when you do that, it's not the end of the world. It's still good because eventually you'll be able to use those losses when you go to sell the property, for example, or if you ever have significant passive income without losses in a particular year. The income from those losses that have been carrying over will offset any income and make it basically zero for the year. So in that sense, it's not the end of the world. But at the same time, why would you spend money to go and do a cost segregation study if you're not able to eat up those losses within a short period of time? To me, that doesn't make a whole lot of sense. So today we're talking about what it means to do a cost segregation study, but you also have to factor in, does it make sense for you to do a cost segregation study? And that part I can't really answer on this. If you have, I gave you a couple hints, tips and hints there in terms of, does it make sense? Likely. Okay. Now, if you have short-term rentals that qualify for the short-term rental exception, which we talked about in one of the videos that I did recently from the Accounting Web Summit. So if you have a short-term rental that qualifies for that, generally speaking, those properties tend to put off a lot of income. And so they don't have a ton of operating losses in those properties. So you'll probably end up having quite a bit of income to help offset. So in a lot of cases, a cost segregation study when you're doing short-term rentals makes sense, okay? Just generally speaking. Whereas in the long-term rental sense, it could make sense or it could not make sense. Just depends on the nature of what you do for your full-time job. Do you qualify for real estate professional status, which again we talked about in a recent video, and a couple other videos that we've done in the past as well. So those are kind of the ways you want to think about potentially, does it make sense to do a cost segregation study, okay? All right. So that said, what is a cost segregation study? All right. So said plainly, it's essentially taking a building that you buy, whether it's a house, a commercial building, some type of real estate, real property, right? And what you're doing is you're breaking down the components of that building. So obviously, as you know, there's a lot of things that go into a house. You got plumbing, you got flooring, you got electrical, you got roofing, you got siding, you got uh, drywall, you have cabinets, you got an air conditioning unit, you got landscaping, etc., etc., etc. Okay, so there's all kinds of things that go into building a house and making it a place for someone to live, and also commercial spaces in terms of making it somewhere for businesses to use. Okay, so what happens is with a cost segregation study, it goes based off of the name. I mean, what you're essentially doing is segregating the building cost into individual components, such as plumbing or electrical or flooring, all that kind of stuff, right? And what happens is we segregate those, and when we do that, those things actually have different lives underneath the tax code, shorter lives. So by default, residential real estate is depreciated over 27 and a half years when you buy it. Okay, so if you don't want to do a cost segregation study, you can just depreciate the building over 27 and a half years as residential real estate, and you get a certain amount of depreciation each year. It's on a straight line basis. Done, good to go. Okay, but if you want to accelerate some of that depreciation and get some of it up front today or this year instead of waiting for it over 27 years, then you can do that. Okay, and what you do is when you go through and you do that depreciation that way, I like to say it works out to roughly about 20% or so of the amount that you're paying for the house will likely end up being an additional first year depreciation, just as a back of the napkin type of hypothesis or calculation you can kind of utilize in terms of coming up with your numbers on whether this deal makes sense or not and how you can be impacted from a tax standpoint. But each location and each property is going to have different numbers, right? And so what we have to do is do an actual study in order to determine what that is. And there's different types of studies that you can do, okay? But, whether or not it makes sense to do it, again, is kind of the first question. The second question is when you're ready to do it, let's talk about how you would go through and do that. So there's two ways you can do it, okay? The first way is you can hire a company and they will go out and actually, inspect the property. They'll, ask you for a bunch of stuff like an appraisal report, your closing documents, stuff like that in terms of buying the property. And what they do is they come up with the individual component costs from that and schedule those schedules, and they go ahead and assign some value to it. And they give you a report that says, okay, here's the shorter lives of these classes, and here's the class that still has to remain at 27 and a half years for residential real estate. And for commercial real estate, by the way, I didn't mention earlier, it's 39 years that you would have to do that, okay? Or for real estate that you're using in your business, that's not considered residential real estate. Now, if you do the strategy where the business doesn't own the property, which is usually how we do this, right? And then you have that property rented from a separate business or LLC that you have, then it becomes residential real estate, essentially, if you're using residential homes in your business, okay? So that's one way to kind of get around that criteria. But 27 and a half or 39 years, those are going to be your depreciation levels, right? And so we're going to get a report and they're going to say, okay, here's how much goes to each category. You put that on your tax return and voila, you get some depreciation. Now, the bonus right now, a little play on words there, is that bonus depreciation is currently in effect. 100% bonus depreciation, to be clear, is currently in effect through the end of 2022. Okay, it goes down to 80% starting in 2023. Okay, so if you've acquired any properties recently over the last several years, we can actually go back when 100% bonus depreciation started and do what's called a 488, or excuse me, a 481A adjustment, and essentially give you some bonus depreciation from prior years and take it for a current year if it makes sense to do that. Okay, and so that's another possibility that's out there that you want to consider. All right, but essentially, this is a powerful tool. The second way that you could do the cost segregation study is you can go and do what we call a software type study, which essentially means you're going in there, you're putting in some basic information, and it's going to go ahead and assign some values on kind of a high level analysis based on a bunch of data and analytical stuff that they've done over the years that has broken it down into various categories. Okay. Now, these tools are typically only going to be for properties that are have a depreciable basis of $600,000 or less, right? And they're usually going to be for properties that are 6 units or less. Okay, so if you acquired a property like that, you can usually get one of these done for a relatively inexpensive amount. It's $1,000 usually is what you could probably get one of those done for. Whereas the full study where you got an actual engineer involved and actuaries and stuff like that, that's going to be more like $5,000 to $7,000 depending on where you get it from, typically. Okay, so if you qualify for this software study, it's probably going to be a better option in most cases because it gives you the ability to go through and do it in a quicker manner. It's a lot quicker, super fast to do the cost segregation study. You just need to know some information about your property, and you can get a report within a few days doing the software version. Okay, so but long story short, powerful tool. There's a couple different ways you could get it done. All right, and what we're going to do now is I'm going to show you a couple of examples. Okay, so we're going to look at an example where the depreciable basis, and what I mean by depreciable basis, by the way, is when you buy a property, you can't depreciate the whole cost. You have to allocate some of it as land, and land, unfortunately, is not a depreciable item, okay, underneath the tax code, meaning it just sits there as an asset, and then when you go to sell the property, you get a reduction of the sales price based on the basis that's in that land that was never depreciated, okay? So it helps to offset any gain that you might have in the future, but you don't get to depreciate it. Now, typically speaking, depending on where you live, land is somewhere between 15% and 25% usually, but you have to take that with a grain of salt. You have to really do your own analysis based on where the property is located and how much land should be allocated towards it. Okay, but let's assume in this case we bought a property for $500,000 and $100,000 was land, which leaves $400,000 depreciable basis. Okay, so let me just share my screen here. Okay, so here we have a like my address there, 123 Anywhere Street. So here we have, like I said, bought the property for $500,000, but the depreciable basis is only $400,000, and it's less than 6 units on this property. Okay, here in Phoenix, you'd be lucky if that was 1 unit. It's how expensive the real estate is here, but I get on a sidetrack here. We're going to assume a tax rate of 30%. Okay. Now, if you have a higher tax rate, obviously the savings are going to be greater. And if you have a lower tax rate, obviously the savings will be lower. But we're going to assume a 30% tax rate, which is about average of what I kind of see, where I see a lot of people that are doing real estate. They're usually going to be close to that between federal and state taxes. Okay. But it all depends on where you live is going to drive your tax rate. Okay. But essentially, what this report is showing is on $400,000, it's estimated that you'd get between $50,000 and $75,000 of additional first-year tax deductions. Okay, so let's do some math on that. So of your purchase price, or not purchase price, excuse me, the depreciable tax basis, you're looking at additional first-year deductions of 12.5% to 19% roughly. Okay, so you're looking at additional first year deductions somewhere in that range. Now, I will tell you, in my experience, they tend to be closer to the higher part of this range. All right, but this is again a conservative estimate of what you could expect. Now, what do those deductions equate to from a tax standpoint? These are your savings right here. So you're saving between $15,000 and $22,000, assuming you have a 30% tax rate in the first year from the bonus depreciation. Okay, and this is again a $400,000 taxable basis on that property. Wouldn't you like to save that much money just by doing a cost segregation study? Okay, now this again assumes that we talked about earlier, that you can actually utilize it. All right, and if you can't utilize it, then your savings are not all that great. Okay, so you have to kind of, again, this is very high level example here, but your savings are going to be somewhere potentially in this range, assuming you can utilize it all, like we talked about earlier. Okay, and so that's a scenario, like I said, with $400,000 depreciable basis. So if you had to spend $1,000 to save this much in taxes, would you say it's worth it? I would say it's worth it. Yeah, it's probably worth it, right? It makes sense in this scenario to do it. Now, let's say that you didn't buy a property that was worth quite that much. You're in a lower area where the property's, I still have Phoenix on here, but you're not finding a property in Phoenix for $200,000. I'm going to tell you right now. If you do, it's going to be something that you probably need to tear down and rebuild. But let's assume that you found one somewhere else, wherever it is. I don't know. And let's assume you bought the property for $250,000, and the depreciable basis is $200,000. Let's just make those assumptions there. Okay, so bought the property for $250,000, depreciable basis $200,000. All right, so here's what you would get. You get additional first year deductions between $25,000 and $37,000 roughly. Okay, your cash flow, essentially tax savings. In this case, I actually dropped it down to 25%, kind of assuming that if you got a lower end property, maybe you're not quite as high on the tax scale, and also just kind of give you a little bit flavor of what you could potentially save at different income levels. Okay, so let's assume federal and tax rate of 25% in this case. Your savings would be $6,200 to $9,300 in taxes. Again, this is assuming that you can utilize the cost segregation results and actually save yourself that money. Okay, so if that was the case and you saved, $6,200 to $9,300 in taxes, again, spending $1,000, does it make sense? I would say yes, it makes sense. You're still netting $5,000 to $8,000 roughly in tax savings. So again, assuming you meet the criteria and you can actually utilize the losses to help offset your other income, or maybe you don't have losses, frankly. Maybe you actually have a high income because you're doing short-term rental, and this will just offset your high income from the short-term rental to where you don't really have any income left. And so in that case, you're able to utilize it all as well. So, there's all kinds of different possibilities you could use with this. Okay. But needless to say, long story short, that's a couple examples of the cost segregation, reports that you would get from a software type model. Now, this is just a high level summary. The reports you get are a few pages actually. And so they have a breakdown of everything that you can actually use to go and do the tax return, plus an Excel file you can give your accountant, et cetera, et cetera. All right. Now, I will say that, CPAs or EAs or whoever kind of helping you with your return probably has their own vendors that you could utilize. If for some reason your CPA or EA isn't a fan of cost segregation studies and it's something you really want to do, we could help you out here. So we have a connection to a company that offers this type of tool that you can go through and get it done. Like I said, for about $1,000, and save yourself thousands of taxes potentially. But before we would recommend you doing this, again, we're going to sit down and talk to you, look at your scenario, and make sure you're actually going to be able to utilize it, or at least you go into it knowing you're not going to be able to utilize it right away, but you might be able to utilize it over the next 2 to 5 years. If it's going to take you longer than that to utilize it, we generally probably wouldn't recommend doing it because it's kind of a waste of money, to be honest. But every scenario is different, every person is different. So if you really want to do it, then we will help you get it done. Okay, whether we need to do a full study or whether we want to do a software study, it all depends on your risk appetite. I will tell you, the vendor that I use to help out with this software study model for the cost segregation reports has been audited, I think, one time since they've been doing this, and it passed with flying colors. And if your return ever gets picked for an audit, they will absolutely defend the results that come from it, and make sure that nothing negative comes to you. So I don't think that there's going to be anything wrong with doing a software study. Otherwise, I wouldn't recommend people utilize them, to be honest. So that's about cost segregations. Pretty straightforward. It can get a little complicated, a little intricate in some cases, but for the most part, it's pretty straightforward. And hopefully you guys enjoyed. If there's any questions or anything, feel free to let me know. Again, like, subscribe, all that good stuff to the channel. And we'll be back with more awesome stuff for you in the near future. Hope everybody has a good one. Bye.